Kapoor, senior economist at RBS, joins in to make more of these. Gaurav, to start off with, the FY13 GDP growth at 5%, what would be your first reaction?
The number is slightly lower than what we expected. We were working with a number of 5.4% for the year. The number at 5 it obviously goes to show that some of the manufacturing slowdown which we have witnessed throughout this year is unlikely to see any significant pickup in the second half of the year. We now have the data for till about November. So there is that manufacturing slowdown, the weak monsoons, and the impact of that the impact of slower months of manufacturing sector on services. All of that put together, is shown up in a number slightly lower than what we were expecting. But I mean, it goes to make the point that the kind of slowdown which we have witnessed over the last couple of years is actually very alarming. And the efforts taken by the government recently to revive investment sentiment, I think, will need to be kind of perhaps more steps need to be taken so that the investment activity can pick up and we can move towards 6% kind of growth in the next financial year.
Gaurav, it does look like that you've put a finger exactly on the weak points that the government's also spotting, because the manufacturing growth forecast now is at 1.9% versus 2.7%, and even the services sector, they're expecting the growth to be at around 6.6% versus 8.2%. So give us a sense of, besides these, what are the other key triggers one needs to be watching for, because there has been some bit of a bit of a downgrade that they're talking about even as far as the industry growth is concerned. However, mining as well as construction is expected to see a bit of a pickup.
Well, actually, from the numbers you've just spoken about, I think the fact that services number is actually the overall estimate for the year is below 6%, is actually below 7%. That to me is, again, that's another point of a point which looks as if the services sector, which we know clearly is 60% of GDP. Now, if that is growing way below its trend, and the trend growth in services sector is somewhere between 8.5%. So this is a sign of an overall weakness in the economy. And I think going forward, while the recent numbers have shown that there is some degree of bottoming out in the slowdown, recovery will take time, and I think the recovery will ultimately be dependent on manufacturing sector revival, which in turn has an positive impact on the services sector. And let's hope for a normal monsoon next year. So I think these numbers are again pointing to the fact that growth has slowed down very, very sharply. And a lot of the slowdown is on account of slowdown in investment activity. I don't know whether you have the numbers for investment to GDP ratio, but if in the last for the data which is available, I think between 10-11 and 11-12, there was almost about 1.5% or close to 2% slowdown in the investment rate. And more alarmingly, the savings rate fell by almost 4% of GDP. Now, these are worrying signs for the economy, which points toward structural problems in the economy. And we know that on the savings side, RBI has been talking about the fact that there's been an increase in physical savings vis-a-vis financial savings, and the impact of that is visible in higher interest rates, which in turn impact the economy. So this is, I think, the kind of slowdown which we've seen from the peak levels. I think this is actually a broad-based slowdown. So I think efforts will need to be made to ramp up, particularly ramp up the investment activity so that the manufacturing sector starts to take off. And in fact, even on the other than investment, in recent months and in recent quarters, we've seen even consumption beginning to slow down. So that's another alarming fact. So well, while there is evidence that things have bottomed out, but we will need to see the impact and the implementation of the recent measures taken by the government, what kind of that does really have a positive impact on the investment activity, first of all.
Gaurav, with respect to the GDP numbers, do you think that as long as the GDP growth story is going to be led by consumption demand and not investment demand, that the slowdown is not likely to reverse anytime soon, given that, consumption increases the productive capacity and prices will continue to remain under pressure?
Well, I think we've always been a consumption-driven economy. That in fact, that acts as a buffer during times of global stress. But years of high growth have always coincided with fairly rapid investment activity. So if we are to achieve faster growth, in fact, higher levels of growth, the kind of growth we saw in about a couple of years ago, then we will need to revive investment activity, because that ultimately adds to the ability of the economy to grow on a consistent and a sustained basis without really pushing inflation higher. So, because consumption only, you're stressing only on consumption driving growth, then you have a pattern where along with growth, you see inflation picking up as well, as we've seen in the last couple of years. So while growth is slowing down because investments have slowed down and even consumption is now beginning to show signs of slowdown, inflation remains fairly high and sticky. So I think the government will need to make sure that the measures which have been announced, they're implemented so that you have an all-round consistent effort in terms of increasing the investment activity in the economy, increasing the overall productive capacity of the economy, so that we can achieve higher levels of growth in a sustainable manner. As of now, it's very difficult to pinpoint what is the trend rate of growth of the economy. Well, if you go by the past revisions of numbers, I think it's only in the past year when we've seen investment slow down, fairly sharp slowdown. 13-14 is another year where investment activity slowdown has extended, and that's showing up in the kind of broad slowdown we've seen. So I think going forward, it's very, very critical to revive the investment activity, and at the same time, I think with somewhat easier interest rates, you will start to see some improvement in consumption. But an overall improvement in consumption will also be dependent on how inflation, at what levels does inflation settle down. We know inflation is moderating, but it remains fairly high compared to what we've seen in our recent past. So I think the revival activity or the revival of the economy is critically dependent on revival in the investment activity.
Okay, so it is going to be revival of the investment cycle as well. That's going to be critical. But Gaurav, it's just not internal consumption, the external demand as well, given the situation that we have globally, that's been a big, letdown as well. And not just that, the trade deficit figures aren't very encouraging at all. We've got the weakness in rupee over the last few months. That's been playing out very heavily. The fact that we've had, elevated demand for gold imports, for oil as well, that all those factors seem to have come together, and led us to a situation where the balance of payment is also a big critical question.
Right, that's true. In fact, I think the current account deficit at this point in time is a much bigger challenge on a macro level, and RBI has very rightly identified that in the last policy, the recent policy, the fact that the current account deficit came in at about 5.4% of GDP in the second quarter of the current financial year. I mean, points to the kind of external imbalance or external pressure which can build up, or which already in fact has upon the economy. And with this kind of with these levels of current account deficit and with this heavy reliance on these volatile capital flows largely from FIIs, I think that again adds another degree of risk to the economy, because we've seen a weaker rupee adding to inflation, adding to the fiscal deficit, and adding to the levels of stress on corporate balance sheets. So I think this is, so to the extent we can curb our trade deficit, either through curbing gold imports or by rationalizing consumption of oil, especially in an environment where global demand is still fairly weak, as we can see in consistent negative growth in the exports. I think so this is actually another big challenge which is emerging, and ultimately I think this is a point where everything is culminating into this kind of fairly strong external imbalance. I mean, your current account deficit is a sign of many structural problems. High demand of gold is a sign that the financial sector in the economy, or the financial savings I was talking about earlier, the reach of the financial sector is not far and wide enough to capture financial savings or to increase the level of financial savings. And it's also a sign of the fact that inflation is very high and gold is a hedge against inflation. So yes, I think the external situation now, I think, is a bigger challenge than it was, say, earlier last year.
Gaurav, thanks very much for taking time out and joining in and giving us your assessment of the FY13 GDP numbers, which have come in at 5% versus 6.2% on a year-on-year basis. You've got all of the components, including industry, services and construction, which has slowed down.